Hello and welcome to the Beginner's Guide to Options presented to you by Trade Tips. My name is Kenny and I am one of the analysts here at Trade Tips. Today we're going to be breaking down exactly what is an option and look at the anatomy of what an option is so that we can better trade it as traders and know exactly what we're dealing with when we go out in the markets. Now, what are options? Options are stock derivatives. What that means is that the price of an option is derived from the stock itself. But when you're buying a stock option, you're not buying the stock exactly. You're buying an obligation or a contract. So again, these are based on contracts, not stock. So if we say that we're in an Apple or a Tesla option call, that means that we're owning one contract for it. Now we'll be breaking down what these contracts are exactly and how they're priced and all of that jazz. Now, one big difference between stock and options is that the stocks are usually traded on the New York Stock Exchange, whereas options are based on the CME or the Chicago Mercantile Exchange. And the hours of operation are just the normal market hours of 9:30 a.m. to 4 o'clock p.m. in Eastern Time. So there is no pre-market or aftermarket hours when it comes to options. So if you see a stock goes up after market, you won't see that price get reflected into the option call until 9:30 a.m. Eastern Time the next morning. Now again, so call options are basically just bets that the stock is going to go up. And if you wanted to get some protection maybe against your stock, you can actually buy a put. Or if you want to bet that the stock is going to go down, a put contract allows you to bet a stock goes down and you can profit when the stock goes down by buying a put contract. Now, I want to do a big disclaimer for you guys. Options are very risky, especially if you don't understand what's going on, but that's probably exactly why you're here today, so we can actually break down what exactly an option is. So let's look at a call option, and we're actually not going to be talking much about puts today, just because what a put is just a call option, but just in reverse, okay? So everything that you learn about calls, just think the opposite in case you are interested in buying a put on a stock. So again, so for a call, that's a bet that the stock is going to go up. What that is one contract gives you the right to buy 100 shares of XYZ at a predetermined price. Now, it sounds like a handful at first, but that's why we'll be giving you guys examples and diagrams of maybe how that looks like in the real world when we go ahead and buy a call option. Now, you can't just buy 100 shares of XYZ at any, as long as you want for forever. There actually is an expiration date to it, so that in case you wanted to exercise that contract or exercise that call option, you would have to do it on or before the expiration date. And the expiration date plays a big key to how the option contract fluctuates, so it's important to understand maybe the time horizons and understand maybe what kind of expirations we want to do. And we'll be breaking that down on the next video. The strike price refers to that predetermined price that we're talking about, where you're allowed to buy 100 shares of. And when we talk about the premium, that refers to the price of the contract itself. There's a lot of moving parts to describe why the price of the contract changes, and that's exactly what we'll be breaking down today as well. And why would we want to buy a call option? Well, it's actually a cheaper way to get exposure of a stock. Now, for example, if Tesla is trading at $900 and you want to buy 100 shares of it, that would be $90,000. Now, I don't know about you, but I don't have $90,000 I'm willingly ready to spend on a Tesla stock. Why not instead buy a call option, which could be a lot cheaper way to get exposure of maybe a move to like 1,000, for example. I do want to let you guys know that you are not obligated to exercise your option. So if you're saying that you wanted to, you bought a call option and you're like, well, I don't have the money to buy that. It's like, well, you're not obligated to buy it. So we'll usually just trade the price fluctuations of the call option itself. And we will usually always sell before expiration, and you will never try to be obligated to buy that stock at that time, at that price. So let's say that Trade Tips goes ahead and sends you a text message, and they say the open one XYZ at 319 for $100, and it's a call at $8.00. Now that sounds like a handful at first, but let's go ahead and break down piece by piece and see what we're looking at. So if we wanted to get a contract, we usually will, if we were to tell you how many that we're buying, well, that's that first phrase or that first segment of the call out refers to how many contracts we want to buy. Now, your ticker symbol is represented here in the XYZ, so that could actually be, if you wanted to buy Apple, that's AAPL. If you want to buy Tesla, that's TSLA. The next portion is the expiration date. Let's just say theoretically today is February 19, and let's just say that this is 4 weeks out. Okay, usually you want to buy at least 1 month's worth of time so that we're not overly hit or overly exposed by time decay. And we'll be talking about that more in the next video. But we want to make sure we get at least 4 weeks out worth of time. Our strike price is, in this case, $100. Now that means that you have the right to buy 100 shares of XYZ at $100. Now we'll be talking about that more in the next segment. The type of contract here, so this usually is just going to be a call or a put. And then the premium is described here, and that's the cost per share. So the 8.00 represents that you'll be paying $8 per share and times 100 shares. So the question is, well, how much is this whole contract worth? So what we do for the total cost is you take that $8 right here, and you times and it's going to be $8 per share, and we're buying 100 shares because that's what the contract states. And if you do that, it's going to be $8 times 100, and so the price to get inside this trade would be $800. And an easy way to think about it is if you're timesing anything by 100, there's 2 zeros on here, so you just move the decimal place over twice. So 1, 2, and that should give you 800. Okay. Let's do an example of a call option. Let's say that our analyst here sees a double bottom forming in stock XYZ, and he says, hey, we're going to go ahead and open one XYZ, expiration date 3/19, $100, call at 8.00. So we go ahead and enter that trade, and we'll usually start out here with, of course, $0. And we may not be perfect every time with our entries, so realistically what you might see is your position might go down, but until you get the message to close, like, don't freak out, this isn't how much you've lost just yet. What if the price goes up exactly what we're looking for? Well, if it actually does go in our favor, we can go ahead and see that now at $100 the stock went up to $100, and the of our contract actually increased by $375 or 46%. And if it goes to 110, then it looks like our position goes up by $1,000. And at that point, if our analyst thinks, okay, hey, that's good enough for us, we'll go ahead and take it. We'll usually go ahead and signal it here. So we're going to go ahead and close XYZ, and we'll tell you guys, close that at 120%. Now, again, it's even when you're closing a position, it's not always perfect. So maybe you see 1025, but actually you only get 960. Good enough for us. I don't know about you, but making 120% on your money is still good enough. And I don't know who wouldn't be happy with seeing a game like that, right? So let's go ahead and just see this play by play again. We're just doing a little review of what that looked like. So first, your entry, the stock was at 90, you were at 800 just to get in. The stock goes up to 110, so your contract goes to 1175 total. And at the exit price, you exited with your equity at 1760, and when the price was at 110. So in order to get your profit, all you do is you take your exit price, or how much you sold it for, so 1760, and then you're going to subtract that by how much you entered. And that should give you a profit of $960 or 120%. Looks like a really good trade, and I wouldn't ask for anything else, really. If we wanted to go ahead and compare how that would look like, it's like, let's imagine if we actually just bought 100 shares of XYZ outright at the price of $90. So in order to get inside this trade, you would have to have $9,000 in your trading account. And if the stock goes up to $100, then okay, it looks like you go to 10 grand. And when you leave, the ending price would be $11,000. And so again, we take the exit price minus our entry, and it leaves us with a profit of $2,000. Now you can see here our percentage isn't as much because we ended up putting a lot more money down in order to make the $2,000. So we want to see, well, okay, well, we clearly made a little bit more money. So last time we made 960 bucks, but now in here in this trade, if we coughed up $9,000, we could have made 2 grand instead. Well, here's the cool thing about options. Well, it's as simple as just buying maybe 2 contracts if you want to get the same thing. So instead of being 800 for one, now we're going to buy 2 contracts for a total of 1,600. Let's go see how that plays out. When it hits 100 bucks, you would have made you're at 23.50, and at the exit price, you would have left at 35.20. We take that exit minus our entry, and that leaves us with almost 2 grand. Now, how cool is that though? Instead of coughing up $9,000, you only needed 1,600 for the trade, and you still made the same amount of money. And so if you compare that, like we said, call options are a cheaper way to get exposure of a stock. You wouldn't need $9,000 in your trading account to make 2 grand. All you really needed was only 1,600. So that's really cool. It allows us especially with small trading accounts to grow our accounts faster. And especially if you see something where you aggressively want to get in, and instead of, for example, at $9,000, if you wanted to use that capital to buy 5 contracts, you can imagine how fast this would have grown. You would have made almost $5,000 or $6,000 with the same amount of money. Okay, so let's go ahead and talk about the types of contracts there are out there. So when we refer to an out-of-the-money contract, that's when the contract strike price is above the current price. So let's say that the current price is $90. Well, if we buy a $100 call, you can see that the strike price is above the current price. Now, the reason why you want to buy out of the money is that it's cheaper, but it has a lesser chance to be inside the money. So what are the chances that the stock price in the future is going to be at 100? Well, technically it can also go to 82. So that's kind of a little bit riskier, but the trade-off is it's a lot cheaper. And especially if you're confident in the move that it's going to go to $100 or higher, maybe this is exactly the type of contract we want to buy. So how about if we waited until the price went to $100? Well, if we bought a $100 call, our strike price is equal to the current price, and that's what we call at the money. Okay, so these are usually moderately priced. You risk more, but if you'll also gain more. So if you goes to 110, you'll gain more. If it goes to 90, though, you'll lose more. So that's kind of the double-edged sword with buying at the money. Now, if you buy in the money, which means that the price right now is 110, and we project that it's going to go higher, but we buy a contract that's 100. Usually these are really expensive, and we rarely buy these, and the only time we really want to buy them is if you want a high delta. Now that's really confusing and to talk about right now given what we have, but I just want to let you know right now, we'll typically just never buy a in the money option. There's just so much better usage and utility in buying either out of the money or at the money. Because a lot of this is already priced in when you're already in the money. So we don't usually advise buying in the money. So let's talk about, exercising an option. So remember that you have the right but not the obligation to buy the contract. So you can exercise your option. You can exercise your option at any time on or before the expiration. And so in this example here, we have XYZ 319 $100 call. Right now, well, this is out of the money because right now the stock price is at 90, and we're buying $100 call, and the price of the strike price is above the current price. So if you were to exercise right now, like let's say you bought the call, but the price is at 90, and you wanted to exercise it, that would mean that you would buy 100 shares at $100, which would be kind of useless because if we can buy 100 shares at $90, then why the heck would we want to buy it at 100 and sell, for example, we bought it at 100 and we sold it for 90, we would sell that for a loss. So it wouldn't be worth it. So again, exercising out of the money contracts would result in a loss, and this is why we'll never exercise, or rarely do we ever exercise any of our options before expiration date. And again, yeah. So we don't want to reiterate that we'll typically never ever exercise an option. We're just trading the contract price fluctuations as opposed to trying to actually buy 100 shares of the stock itself. So let's just say, well, okay, well, Kenny, I'm super interested though. Like, what would happen if we actually exercise the option? Okay, so well, let's break it down piece by piece. So if we bought the contract, we would have paid $800 just for the premium, and now let's go ahead and exercise it. We'll go ahead and buy 100 shares at $100, and that would take $10,000 to do. The total cost of this current trade would be $10,800 in your trading account would be required in order to do this trade. And if you were to sell the 100 shares at the current price of $90, you would receive $9,000, which brings you to a grand total of negative $1,800. Now, I don't know about you, but if you wanted to buy this contract and lose money, that's kind of not the goal here. So obviously we're here to make money. So exercising out of the money isn't exactly what we're trying to do here. So again, want to reiterate what's happening with this. We're only trading the price fluctuations. We're not trying to acquire 100 shares of the stock. Let's say that, okay, well, I bought the contract out of the money, and we waited for the stock to go to $100, and it does. So, well, what that would mean, you still pay the premium. The only difference now is that instead of selling the shares at $100 or at $90, now you're selling it at $100. But because we paid for that premium costed $800. We didn't even break even. We are still down negative $800 because we paid so much for the premium. So even if you exercise at the money, you would have lost money. Now, if we waited until, let's say we got the contract here at 90 and now the price skyrocketed to 110. If we wanted to now exercise that contract, we've only made $200. So in the last example before, remember we made almost $960 just on the price fluctuations. Why would we want to give that up for just 200? So again, even when it's in the money, we still never want to exercise our options before our expiration date. So in order to get the price of the options, it's quite complicated. They use a lot of a very complicated pricing model with derivatives and a whole bunch of crazy calculus things, and that makes for us setting the option our profit targets and our stop loss is very difficult, and that's why we'll usually just look at the stock itself and kind of watch it in order to tell you guys when it's appropriate to take your profit or leave. In case you guys were wondering how it looks like to price an option, they use the Black-Scholes model, and this model here represents the price of a call option. And I don't know about you, but that's quite extensive and a lot more complicated than I need things to be. Especially as a trader, you don't need to use any of that. We can actually simplify the model down very much so by using just this equation right here. And it's that the premium is just going to equal to our intrinsic value plus our extrinsic value. Now, that's a little complicated right now because you're like, okay, well, what is those things? What are those things? So we're going to go ahead and break that down. Now, intrinsic value refers to the value if you exercise the contract. So for example, we look back at our in the money call option. If you wanted to ask, well, what is the intrinsic value of our in the money call option? We look to see that this would be almost like $200, or how much money you would have profited if you were to have exercised this contract in the money. Now, when we talk about extrinsic value, that's the everything else. So the everything else refers to is the implied volatility and the time value. Now, implied volatility is just based on the recent price movements. So if the price moved from 100 to 110 down to 90, you can see that there's a large price swing over there. So usually when you see large price swings, that equals to a higher implied volatility. Now, like for example, let's just say you go from 100 to 101 to like 99. That would be a lower price swing. So you'd get like lower implied volatility. And depending on how volatile this stock is, goes into how much the cost of the premium gets. The next value in the equation is the time value, and that just refers to, well, how much time is left in the expiration. Well, if you have, for example, if you're expecting a $10 move that's going to happen in a day, that's super unlikely. So you would expect a super small time value. The price of that contract would either lose value or it'd be cheaper than normal because there isn't much time left for you to do a $10 move in just a day, as opposed to if you were expecting a $10 move in about a month. And just in short, we really want to buy time on our contracts, because if we're left with only 1 day or 3 days left in expiration, then you'll usually see that the price of our premium drops dramatically. And especially if we're buying a call that's $8 and it goes down to like $4 in like a day, that's not exactly the kinds of risk that we want to be taking. So let's go ahead and take an example of our stock where it was out of the money at first, and we want to ask, okay, well, how much does our premium change, and what parts of the equation kind of goes into our premium equation. So we're going to take our contract, and for example, this one costed $8 or 800 because you times it by 100. And you ask, well, what is our intrinsic value? Our intrinsic value is nothing. It's worthless. Because if you were to exercise out of the money, you would lose money. So instead of being a negative value, we'll just say that the intrinsic value is 0 or it's worthless. But what about the rest of it? Well, the rest of it comes from the extrinsic value. They saw that the price of the stock moved from 80 to 90, and it's pretty large price swing. And if people expect that they can bring that up to 100, well, that's reflected here in how much time is left. Let's say we have 1 month, and the implied volatility is showing that, you know, we have it's possible for us to hit that $100 strike price. Then it's going to be reflected with this very expensive premium of $800 in this case. So let's go ahead and take this example again. And so we bought our contract for 800, and now our contract's now at 1175. Just remember again, our intrinsic value is going to be 0, because when we looked at our at the money option, even when we're at the money, because of the premium that we paid for, we're still negative. We still would lose if we exercise this contract. So this contract is worthless. So that's why we have an intrinsic value of 0, but our extrinsic value is going to be 1175 now. And that's because now we hit our $100 price target. Our implied volatility expects us that we can even go higher from here and make even more profit, and even have a chance for us to go more in the money. And if we still have about 3 or 4 weeks left, then we have good odds. And so that's reflected here in our premium price, and we would have made 50% of our money just trading the contract prices itself. Now, let's say that the price actually does go in the money and it goes up higher from $100 to 110. You'll see that the intrinsic value here is now 200, because if we were to exercise our contract, it would be 200. And the extrinsic value means that we still have like 3 or 4 weeks worth of time. We can still go deeper in the money. Therefore, it's represented and priced into our contract here, and that's why our price of a contract now is at 1760. And that's when we went and go ahead and said, hey, you know what, we'll go ahead and take profit here. We can go ahead and just take 120% or our 1760 and just leave with it, right? So again, we want to kind of look back and see kind of what review everything that we talked about in this lesson. Remember that the options are stock derivatives. They are not stock itself. They're based on contracts. So we're buying call contracts. We're not buying stock itself. One reason why we want to buy options instead of stock itself is that it's a low cost way to get exposure in the stock. You remember before we paid 1/5 in price for those XYZ calls, but yet we still made the equivalent amount of money had we put $9,000 down in that example before, when we looked at call options versus buying the stock itself. If we just remember too that the expiration date and the strike price play a big role when it comes to the premium of the option, so it's important that we choose those correctly, and we'll be talking about that in a later video. And that in order to calculate the premium, it is just the intrinsic value plus the extrinsic value, and the extrinsic value includes how far the or how much the price swings, including how much time is left in the expiration. So in general, we want to buy we would like to buy stock where they have a lot of time in it and that they're not too volatile so it doesn't swing against us, and we want to try to get nice and consistent plays for you guys. So having lower implied volatility means that we have less price swings in our premiums, and we can able to make consistent money in the markets. We'll be talking more about this in a later video, but remember the options are very risky, because if you can see that if we bought a weekly option here, let's say for $500, it has the price to go all the way down to zero just because of the nature of options. In general, we want to buy things with at least 1 month's worth of time, 2 weeks probably at like minimum, but like at least 4 weeks would be ideal. And that's because of those of ideas that we'll talk about in later videos, and that's coming from usually IV crush and time decay. And again, those things we don't have enough time to talk about in this video today, but that's the reason why. But because of these things will be the reason why we'll want to take our profits early and make sure that we still have a lot of time with it. Now, maybe some of you guys are thinking, well, you know, when we put out the options, so why not buy just, you know, in 1 week or 2 weeks if we expect to move? Well, that's because if we buy 1 week or 2 weeks out, we'll be fighting against this time decay here, and we'll go more in depth in that in the next video. So again, thank you guys for listening in on our beginner's guide to options. With that being said, have a good one, and my name is Kenny. We'll see you in the next video.